5 agents. Ultimately, they'll have 10 to 12 agents per user. So think about it. We're going from having 750 million users of our software to 8 to 10 billion agents.
Wow.
Okay. Now, these agents work 24/7, 365. If you tune them properly,
They stay fully engaged.
Fully engaged all the time. They don't have to, go and, pick up kids from school and all that sort of stuff, but which creates a whole...
In late 2025, a quiet directive circulated through the corridors of American finance that signaled a profound shift in the relationship between capital and labor. Vista Equity Partners, a colossal buyout firm managing more than $100 billion in assets, signaled a decisive strategy to its investors: the reduction of workforce headcount through the aggressive implementation of artificial intelligence. The firm, led by Chief Executive Robert F. Smith, projected that workforce numbers within its operational structures and potentially across its vast portfolio of software companies could fall by as much as 1/3. This was not a projection based on economic contraction or market failure, but rather a calculation of efficiency. It marked the moment when the theoretical promise of generative AI transitioned into the hard, logistical reality of corporate restructuring. The announcement by Vista is symptomatic of a broader, systemic transformation sweeping through the United States economy. For decades, the growth of a company was inextricably linked to the growth of its workforce. Revenue expansion required human expansion. However, the trajectory of 2025 suggests a decoupling of these two metrics. Vista plans to utilize AI agents to execute routine production tasks, compiling investor presentations, synthesizing marketing materials, and aggregating data for deal sourcing work that traditionally formed the training ground for junior analysts and associates. The Financial Times reported that Smith delivered a stark assessment to his peers, suggesting that in the coming year, 40% of the people in the industry would have an AI agent augmenting or replacing their workflows. While sources later softened the comment as provocative, the underlying logic remains undeniably rigid. The era of linear headcount growth is ending. To understand the gravity of this shift, one must look backward to the evolution of the private equity model. In the 1980s, the leveraged buyout boom was predicated on financial engineering and operational austerity. Firms would acquire undervalued companies, strip away inefficiencies, often defined as excess labor or unprofitable divisions, and resell them for a profit. This was a process of manual restructuring. By the early 2000s, the focus shifted toward growth equity, particularly in the software sector. The rise of software as a service, or SaaS, meant that value was created by scaling sales teams and engineering departments. The primary metric was the seat software was sold on a per-user basis, meaning that the software industry itself had a vested interest in the proliferation of human workers. The more employees a client had, the more licenses they bought. The current pivot by Vista and its contemporaries represents a fundamental inversion of that model. As reported, Vista is exploring commercial models that charge by usage rather than per-seat subscriptions. This is a tacit admission that AI agents will reduce the number of human users required to operate software. If a single AI agent can perform the work of 5 human analysts using a software platform, the vendor can no longer rely on selling 5 licenses. They must instead monetize the output of the work itself. This economic realignment incentivizes software companies to build tools that actively reduce the need for human operators. The technology is no longer a tool for the worker. It is becoming the worker. This phenomenon is not isolated to the portfolio of a single private equity firm. It is visible in the strategic recalibrations of the world's largest technology conglomerates. In late 2025, Amazon announced plans to eliminate 14,000 corporate positions. While leadership framed this as a necessary resizing following the hiring surges of the pandemic era, the subtext of automation was evident. Beth Galetti, the Senior Vice President of People Experience and Technology at Amazon, described the current generation of AI as the most transformative technology since the Internet. enabling the company to organize more leanly. The objective is to strip away layers of middle management and bureaucratic oversight, replacing them with algorithmic efficiency. The implications for the labor market are statistically significant. A survey conducted by Goldman Sachs in late 2025 offered a nuanced view of this transition. Analyzing the behavior of their corporate clients, the bank found that while 47% of companies were utilizing AI primarily to boost productivity and revenue, a significant minority were already executing headcount reductions. In the technology, media, and communications sectors, industries that serve as bellwethers for the broader economy, 31% of companies reported mass layoffs driven by AI adoption. The investment bankers polled by Goldman Sachs predicted an 11% decrease in client headcount over the subsequent year, with financial institutions leading the contraction at 14%. This data challenges the optimistic narrative that AI will strictly function as a co-pilot, merely aiding human workers without displacing them. The productivity versus displacement debate is often framed as a binary choice, but historical precedents suggest they are sequential phases. In the early stages of technological adoption, firms use new tools to make existing workers more productive. However, as the tools become more autonomous, the necessity for the human loop diminishes. The Vista Equity Partners case illustrates the transition to this second phase. The firm is not merely giving AI tools to its junior analysts, it is building agents that can execute end-to-end workflows with minimal human intervention. The causal forces driving this shift are multifaceted, rooting themselves in the macroeconomic climate of the mid-2020s. The era of zero interest rate policy, which defined the decade leading up to 2022, allowed for bloated valuations and massive headcount expansion. Capital was cheap, and efficiency was secondary to growth. The subsequent rise in interest rates forced a return to fiscal discipline. Investors began to demand profitability over pure scale. In this environment, the high cost of human capital, particularly in white-collar sectors like finance and software engineering, became a target for optimization. Concurrently, the capabilities of large language models and agentic workflows matured to a point where they could reliably handle cognitive tasks that were previously the exclusive domain of university-educated professionals. The intersection of expensive capital and capable automation creates a formidable pressure on the job market. The Brookings Institution and the World Economic Forum have long analyzed the potential for automation to disrupt routine manual labor. However, the disruption of 2025 is distinct because it targets cognitive routine. These are tasks requiring intelligence, context, and synthesis: drafting a legal brief, analyzing a balance sheet, or writing code. These are precisely the tasks performed by the American middle and upper middle class. The junior analyst at a private equity firm, earning a six-figure salary to aggregate data, is now in direct competition with an AI agent that costs a fraction of that amount and operates without fatigue. The human consequences of this shift are unevenly distributed. The narrative of the blue-collar robot replacing the factory worker has been supplanted by the reality of the white-collar algorithm replacing the knowledge worker. The Vista Equity Directive specifically targets operational roles, investor relations, staff, and junior analysts. These are positions that traditionally served as the on-ramp to the upper echelons of the corporate world. If these entry-level roles are automated, a critical question arises regarding skill acquisition. The apprenticeship model, a cornerstone of professional development in law, finance, and consulting, relies on junior staff performing rote work to learn the intricacies of the trade. By automating the grunt work, firms may inadvertently sever the pipeline of future senior talent. Furthermore, the displacement is geographic as well as professional. The remote work revolution of the early 2020s decoupled employment from location, but the AI revolution threatens to decouple employment from humanity entirely. Urban centers that rely on the tax revenue and consumption of dense populations of office workers face a precarious future if corporate footprints shrink by 30 or 40%. The commercial real estate market, already straining under the weight of hybrid work models, must now contend with a permanent reduction in the demand for square footage as companies achieve higher revenue per employee. The divergence between revenue growth and employment growth is becoming a defining feature of the modern economy. In previous industrial revolutions, technology lowered the cost of production, which increased demand, which in turn increased the demand for labor. The classic example is the introduction of the ATM, which lowered the cost of operating a bank branch, leading banks to open more branches and hire more tellers. However, economists at the Massachusetts Institute of Technology and the University of Chicago have posited that generative AI may not follow this pattern. Because AI agents can scale instantaneously, the demand for increased output can be met by simply spinning up more server capacity, not by hiring more humans. Vista's move to allow expansion without adding new hires perfectly encapsulates this dynamic. Growth no longer equals jobs. Education systems are struggling to react to this velocity of change. For decades, the mantra of American education was to pursue STEM degrees: science, technology, engineering, and mathematics. Computer science, in particular, was viewed as a golden ticket to economic security. Yet, the automation of coding and data analysis challenges this assumption. If a private equity firm can automate its data analysis, and a software company can automate its code generation, the premium on these technical skills may erode. The focus is shifting toward AI literacy, the ability to orchestrate and manage these agentic systems, but the number of humans required to manage the agents is significantly lower than the number of humans required to do the work. The concept of AI literacy, referenced in nearly 1 in 4 job postings in 2025, is vague but critical. It implies a shift from creation to curation. The worker of the future is not necessarily the one who writes the report, but the one who prompts the AI to write it, validates the output, and integrates it into a broader strategy. This elevates the value of judgment and strategic thinking while devaluing technical execution. However, judgment is difficult to teach without the experience gained through execution. This creates a paradox where the skills most valued senior-level judgment are becoming harder to acquire because the entry-level roles where those skills were historically honed are disappearing. Wage trends offer another lens through which to view this transformation. While top-tier talent capable of building and directing AI systems commands astronomical compensation, there is a softening of wages for the middle skills of the knowledge economy. When Amazon or Salesforce reduces layers of management, they are removing high-wage roles from the economy. The redistribution of this capital is stark. Money that was previously paid out in salaries to middle managers and analysts is now redirected toward capital expenditure on GPU clusters and software licensing, or returned to shareholders. This exacerbates income inequality, not between the rich and the poor, but between the owners of capital and the sellers of labor. The role of regulation in this landscape remains nascent. While Federal Reserve Vice Chair for Supervision Michael Barr has called for guardrails as the financial sector adopts AI, the regulatory framework is largely reactive. The primary concerns of regulators have been focused on algorithmic bias, data privacy, and systemic financial risk. There has been less regulatory focus on the labor market implications. The United States has no comprehensive policy mechanism to manage the transition of a white-collar workforce into a new economic reality. Unlike European nations with robust social safety nets and retraining programs, the U.S. labor market is highly flexible, allowing firms like Vista and Amazon to pivot rapidly, leaving the workforce to adjust on its own. Looking toward the future, the projections for the next decade are sobering yet clarifying. The McKinsey Global Institute and other think tanks estimate that by 2030, activities that account for up to 30% of hours currently worked across the U.S. economy could be automated. This does not equate to 30% unemployment, but it does necessitate a transition for 12 million occupational shifts. The speed of this transition is the variable that matters most. If the shift happens over 20 years, the economy can adapt through natural attrition and retirement. If it happens over 5 years, driven by the aggressive deployment strategies of private equity firms, the disruption will be acute. The definition of work itself is under renegotiation. For the last century, work was defined by inputs: hours spent, documents written, lines of code produced. The usage-based pricing models being explored by Vista suggest a future where work is defined strictly by outcomes. This creates a hyper-meritocratic but unforgiving environment. In a world where AI agents provide a baseline of competence, human workers must provide value that is distinctively non-algorithmic. High-stakes negotiation, ethical leadership, complex emotional intelligence, and novel creative synthesis. In the final analysis, the move by Vista Equity Partners to replace 1/3 of its staff with AI is not an anomaly. It is a forecast. It represents the logical conclusion of an economic system that prioritizes efficiency above all else. As the cost of intelligence approaches zero, the structure of the corporation will inevitably shrink. The resilience of the American workforce will depend not on fighting this tide, but on navigating the new geography it creates. The challenge for the coming decade is not merely technological, but social. How to maintain a robust middle class in an economy that requires fewer humans to function. The age of the augmented workforce is over. The age of the automated enterprise has begun.